Good day, everyone. So we will be looking at the basic introduction to group accounting, the general overview, and the basic principle we have to know. This is brought to you by Okewa Bayomi, illustrated by the Accounting Media. One of the ways you can support my channel is to press the YouTube subscribe button and the notification so that you can be notified when I release my next video. So the first thing is, what is a group? So if I ask the question, what is a group? There are many things that will come to your mind, but let me paint a simple scenario. The thing is, if I have a company, which is company P, and I have another company X, and in this case, company P owns more than 50% of the equity share capital in company X, what can you say? Which means that company P is a separate entity, company X is a separate entity. But company X equity capital, company P owns more than 50% of that. What can we conclude? The first thing we can conclude is that 1. P can control X because I control more than 50% of the equity capital of company X. So I can control company X. Another thing is, P can manage X as if it is just a department. So far I own more than 50% of the equity share capital of company X. What will happen is that when there is relevant decision to be made, because I control more than 50% of the equity capital, that gives me a voting power to be able to decide. So which means that I will be running X as if X is just a department. So, and this also gives rise that P have enough voting power to appoint all director of X. Yes, because I control, let us assume company P owns 80% of company X. Company P can make decision to appoint all the directors. Why? Because they have enough voting power to do so. So we can then basically conclude that company P and company X can be seen as a single entity, that is a group in its economic substance. Legally, company P is a different entity, company X is a different entity. But in economic reality, I can conclude that company P and company X should be seen as one, which is a group. So, to understand better, we need to understand basic terminology. And according to IFRS 10, the first definition we have to know is who is a parent. So when we want to talk about a parent, IFRS 10 defines a parent as an entity that controls one or more entity. So company P controlling company X, in that case, we can conclude that company P is the parent company. So which name can we call company X? The standard further tells us the definition of subsidiary. And who is a subsidiary? The standard defines a subsidiary as an entity that is controlled by another entity. So we can see that the parent company, company P, control another company, which is company X. So company P who control another company can be seen as the parent, while the company that is controlled is known as the subsidiary. Another thing is non-controlling interest. Now, the standard says non-controlling interest is the portion of a subsidiary corporation stock that is not owned by the parent corporation. Now, very simple. We said if company P control company X, and that can be achieved by having more than 50% of the equity share. But sometimes company P can own everything in company X. But in most cases, company P will have less than 100%, which we call partially owned subsidiary. So in that case, if company P owns 80% of the equity share capital, it means that another company or another set of investors will have the remaining percent. So the portion of the subsidiary equity share capital that is not owned by the parent company can be referred to as non-controlling interest. Before, this is always referred to as the minority interest. So now we've been using the word control. So when can I say that a parent control another entity, which is a subsidiary? There is something I do explain there. I can tell you that control can actually be looked at in two different conditions. We can look at it qualitatively and quantitatively. Though qualitatively is what the standard wants us to look at, not the quantitative aspect. But for the purpose of examination condition, we also look at the quantitative aspect. And the quantitative aspect is, we said a company control another entity if it owns more than 50% of the equity share capital of that company. But IFRS 10 says that a particular company control another company if and only if these three key are present. The first thing is that company P have power over the investee. The next one is that there is exposure or right to variable return from its involvement with the investee. If I have my investment in another company, X, because I have investment there and that investment is in ordinary share capital, I am entitled to variable return, which is my dividend. So which means that I have power and I'm exposed to variable return, and the last thing that must be present is that there is ability to use the power to affect the variable return. I have power, I am exposed to variable return, and I can use the power to affect that variable return. So if I have more than 50% of the equity share of a subsidiary, and I can use that share that I own to control the affairs of the subsidiary, to make them to change their dividend policy, to make them to control some aspect of the operation, it means that I can use my power to affect my variable return. Now, the thing is, when can we say that you have power, or how can we define power? So, the standard says that power is the existing right that gives the investor current ability to direct relevant activity of the investee. Now, before you can have power over your subsidiary, it means that there is an existing right which you actually get as a result of buying the equity share capital of that company. That gives you the right. And because you have right, you have the ability currently for you to affect any relevant decision or relevant activity of the subsidiary. Example of relevant activity is the purchasing decision of the subsidiary. You can affect that. You can affect the acquisition or disposal of a particular investment. You can affect the budgeting decision and the likes. So, during the course of this series, we will be looking at various standards which affect group account, and some of which we will be discussing subsequently are IFRS 3, which talks about business combination. We will be looking at IFRS 10, which is consolidated financial statement. It gives us the guiding principle to prepare our group account. We will be looking at IAS 28, investment in associates, which we will look at later. We will be looking at IFRS 11, joint arrangement. We will also be looking at IFRS 12, disclosure of interest in other entity. And another relevant standard is IAS 27, because company P is a separate entity, company X is a separate entity. Both have to prepare financial statements following the principle in IAS 27. So the next big question is exemption from preparation of financial statements. As a group, IFRS 10 expects us to prepare our financial statements to incorporate the performance of the subsidiary company. But for every rule, there is an exception. So there are some exemptions from the preparation of group financial statement. And IFRS 10 gives 4 of such rules when you can exempt your subsidiary from consolidation. So the first thing is, if the parent is a wholly or a partially owned subsidiary, and the owner of that parent company, they already agree that they should not prepare financial statements, They talk to the NCI, which is the non-controlling interest. They also agree not to prepare, so the company may not prepare. The next point is, if the parent debt or equity instruments are not traded in a public market. What do we mean? So the parent company is just a private company. It is not trading in debt or equity instruments on the security exchange market. So in that case, there is no obligation to prepare group financial statements. So the next one is, the parent did not file its financial statement with the Security Commission or other regulatory organization for the purpose of issuing any class of instruments in the market. So the company is not in the process of issuing its shares in the market, because if you want to issue your shares in the market, you have to meet up with some standing rule of the security exchange market. But if the company is not in the process of issuing any class of shares, in that case, they need not prepare group financial statement. So, and the last one is, the ultimate parent company produces consolidated financial statement. Now, at times, we can have company P, which is a parent to company X, whereas company P can also be a subsidiary to another company Z. So if company Z is going to prepare a consolidated financial statement, in that case, company P may not prepare consolidated financial statement, which make it an obligation for company Z to prepare financial statement. So, and other requirement that we can have, which may make an entity not to prepare a group financial statement. The first thing is, we said, if the subsidiary is held for sales. So if a subsidiary is held for sales, it is expected to be accounted for based on the provision of IFRS 5. So in that case, you need not consolidate the subsidiary. Such subsidiary will be shown as just a single line item on the face of the financial statement. And another reason is when that subsidiary is non-material.